Let's start. Right, we are still busy with the topic of income tax, which is International Accounting Standard number 12. So let's have a recap of what we did in the prior week. So income taxes, right, International Accounting Standard 12, that's the topic. A very important topic, as I indicated before. Right, you need to be very, very clear in understanding of this one. It's a very important topic. Right, remember we spoke about income tax expense. Right, which we said it is presented right in the P&L account. Right, presented in the P&L account. Right, in the line below profit before tax. Right, that's the income tax expense. And then we said the calculation of this figure. Right, the income tax expense. Right, you take what is called current tax. Right, and then you add the deferred tax. Right, then it will give you the income tax expense. So the income tax expense amount is a combination of deferred tax, right, and also the current tax amount. Right, so we discussed this in the prior week. Right, and then in the statement of financial position, right, in the statement of financial position, right, we present, the first item that we present is deferred tax. Right, deferred tax can fall either under non-current asset, if it's a deferred tax asset, right, or it can fall under the non-current liability. So it will go in one of those spaces, either as a current asset or a non-current liability. Right, then we also said in the statement of financial position, you also deal with the current tax, payable. Right, if it's at the end of the year, and this goes to the current liabilities. Right, so we highlighted that when you deal with the income tax expense standard, which is International Accounting Standard 12, right, you'll be affected in terms, right, of the statement of profit and loss, right, in terms of the P&L account, right, by the income tax expense, and we highlighted exactly where you find it below profit before tax. Right, and we also discussed a little bit on how you calculate that particular amount. Then we said in the statement of financial position, you will have deferred tax because deferred tax is either an asset or a liability. So we highlighted where exactly it will appear if it's an asset, right, under non-current assets, if it's a liability and non-current. Right, then we have the current tax payable, which is the current tax for the year. Right, normally at the end of the year, you will calculate that, but it is usually payable in the following year. So at the end of the year, it will appear as a current liability because it is normally payable within a year from the end of a particular year. Right, so these are the particular areas in terms of presentation on the face of the statement of profit and loss and statement of financial position. Right, of course, the other important thing, right, is disclosure. Right, at this level, good people, whatever you study, whichever topic that you do, part of what is important is to understand the disclosure requirements because you will always be examined on disclosure. So even if you understand something thoroughly in terms of calculation, in terms of presentation in the P&L statement of financial position, you are not yet done until you cover the disclosure session as well. Right, so this is where income tax really will affect you in your financial statements. In the exams, of course, you can get discussion questions as well. You can get a presentation question where you have to show on the face of the financials. You can get disclosure, but you also get questions that require you to do discussions. So very important that you are thorough on the theory here, right? Because anything can be asked in this particular module. Right. I think we did a good job in explaining current tax. Let's just recap. Right. What do you understand, good people, by the term current tax? Right. Are we there? Current tax. Right. This is the amount, right, of tax or of income tax payable to SARS. Right. This is the amount of income tax payable, right, to SARS. Right. And then we said this amount, right, is based on taxable income. This amount is based on taxable income, right, at a rate of 27% currently. Right. However, in questions, you must check the question for the rate. Sometimes they give you a different rate from 27%. Right. So obviously here, this is based on tax rules. This will be based on the rules of taxation. Right. So this here is what we call the current tax amount. Right. An important calculation that we have with regard to this, and this is based, this is calculated, right, by adjusting the profit before tax. Right. For number one, exempt differences. Number two, temporary differences. So for you to get the taxable amount, you take your profit before tax in the P&L, right? If there are exempt differences, you adjust for those differences. If there are temporary differences, you adjust for those differences. Eventually, you will arrive at the taxable income. Right. Our focus today is the deferred tax calculation. So we did discuss that, right? But it was at an introductory level. So we'll look more in detail at deferred taxation. Right. Remember, deferred tax, there are two types. Or when you deal with deferred tax, it is either, right, deferred tax assets or deferred tax liability. All right, so I did give a formal definition in the prior week. You can visit last week's lesson for the formal definition. But I did explain and say with a deferred tax asset, it simply means that we would have prepaid, right, our income tax expense for a particular period. Right, with the deferred tax liability, it means that there is an accrual, right, of the income tax expense amount. Right, I gave a couple of examples. I can just give a quick example, very short one here. Right, just to make sure that we are on the same page. Then we can go to the business of the day. Right, assume that an entity achieved profit before tax, right, of 200,000, right, after accounting for accrued expense, right, of 50,000 rand. Right, so let's say this is the example that we have. Right, what will happen in terms of accounting? Right, in the books of accounting, right, in calculating the income tax expense. Right, so what we'll do, we'll then take the amount of profit before tax, which is the 200,000 that we have. Right, so once we have the amount of profit before tax that we have, right, then we are going to say, or let me use a different example. Right, I'll give you another example just now. Right, so let's say we have got 200,000 profit before tax. Right, then we will say included in the profit before tax, are there any exempt differences? That is the question that we'll ask. Remember, tax exempt differences are items of either income or expenses which would have been included in the calculation of the 200,000 profit before tax, which, however, are not taxable or deductible, which means they don't affect tax. So for tax purposes, we don't consider them. But for accounting, we would have included them. Right, so you need to check them out because they will never give out an impact on the income tax expenditure. Right, such things as dividend, foreign income, you know, donations, legal expenses, interest, fines, etc. So we don't have any of those things there. Now, what it means is that the whole amount of 200,000 attracts taxation as long as it does not contain exempt difference. So multiplied by our rate of 27%, right, it will mean that we'll be having a tax amount of how much? Right, this will be 108,000 here. Am I correct? No, it can't be. By 27, that will be 54,000. Right, so you have to understand this 54,000. Right, based on our principles in accounting, this is the amount that we are owing SARS for tax purposes. Right, based on the principles of taxation. Right, are we clear about that, good people? Right, so the question is, how much of this should we pay? Right, are we there, good people?
Yes.
Right, so the big question here is how much of that amount should we pay currently or when the tax window opens. But you must be very clear, the income tax expense usually is your profit before tax, and then you remove the impact of exempt differences. Then the remaining amount is going to give you your expense. Now, the amount that we've got to pay, right, is going to be dependent. Right, let's check the group there. Sharp, sharp. Right, the amount that we are going to actually pay, right, is dependent on the principles of taxation. But when we apply the principles of taxation to determine the amount that we have to pay, right, we are not saying we are overwriting accounting. We are not overwriting accounting. Accounting says 54,000 is the expense incurred. Right, however, we use the amount recognized by tax as payable to determine what we should pay of that amount. So therefore, to calculate that, we do what we have been doing, right? In terms of SARS, we need to calculate taxable income. So we take the profit, right, before tax, which is the amount of 200,000 a year, right? Then we say less. If there are exempt differences, both accounting and taxation always eliminates this. We don't have that, right? But we have temporary differences. In accounting, when determining the expenditure, we don't deduct the temporary differences. Remember, the temporary differences, us and SARS, we are in agreement that something will attract taxation, but we are just differing on whether we should account for it now or in the next period. So we do have an exempt difference, which is the 50,000, right, which is accrued expenditure. Right, so what we would have done in accounting with the accrued expense, right, the accrued expense will not have been included there. It would have been included. That's an accrued expense, we include it here, 50,000. Remember, an accrued expense is an expense that happened before the end of the year or at the end of the year, right? However, we have not yet paid it, but it is an expense for this year. In accounting, we deduct that. However, SARS, when it comes to expenses, especially if expenses are below 50,000, right? SARS does not allow a deduction on these. They will only allow a deduction when the expenditure is paid, right? So here we are dealing with the accrued expense. SARS will only allow a deduction in the next year. So therefore, according to SARS, the amount that is taxable, you have to add the 50,000 back. So this is your taxable income. Right. Any question? Are we clear on that, good people?
Yes, I don't find it. Are you saying we
Yes,
need
sir.
to add? Or I see that after profit before tax, we are saying less.
We actually, I shouldn't say less, I should say adjust. It's plus or minus, ne? It's plus or minus. So it depends, right? If we are dealing with exempt differences, if those were income and were included here, but are not supposed to be included for tax purposes, we need to reverse them by adding. If they are expenses, we would have what? Deducted them here, right? For accounting purposes. But when it comes now to taxation, we reverse them by adding. So this is an accrued expense, right? And this accrued expense, we are saying, in arriving at this figure, we would have already deducted the 50,000. It was deducted in arriving at the 200 for accounting purposes, right? However, when it comes to tax is saying we should not have deducted it. It will be deducted in the following year. So we should be adding it, né? Right, are we together? Right, so ultimately you are going to have 67,500. So this amount of 67,500, this represents the current tax, and accounting also pays based on the current tax. Now, this is your tax for the year according to SARS. And this is the tax for the year according to accounting. But what we'll always do is that we'll pay this amount. So from an accounting perspective, right, we are saying as an entity, we incurred an expense of 54,000, but eventually paid 67,500. So therefore, 54,000 minus 67,500, that will give us 13,500 overpaid. Now, remember, this is an expense. If you've overpaid an expense, this is a prepayment. A prepayment is an asset. However, we call it deferred tax, and this is a deferred tax asset. Right, this is a deferred tax asset. That's why we say deferred tax represents a prepaid income tax amount. Now, that is a definition on the side. Officially, you can visit the study guide or visit the one that we highlighted last week. But for greater understanding, this is prepaid income tax. If the tables are reversed and we have right, assuming we have right, please mute. Thank you. Right, I hope we're sorted. Right, assuming we've got a bigger figure in accounting, okay? Let's say accounting was saying 80,000. Right, then a current tax, after adjusting for difference, was saying our tax is 60,000. Right, so it simply means that remember the expense recognized in accounting is that the expense that we are going to pay based on taxation principles is that we are going to have 20,000. So which means we underpaid tax. This is an accrual. An accrual is a liability. This is a deferred tax liability. Right, so in this instance, we'll have a deferred tax liability. Right, here I was just introducing this simple example for your understanding so that you have a mental understanding of what deferred tax is. Right, however, when you do your calculations, right, when you do your calculations for the current tax, when you do this calculation here, right, this is the correct way of doing it to earn marks in the exam. And this is the only method that you're going to apply. So here we apply what is called the statement of financial position approach. Right, the statement of financial position approach. Right, in calculating the movement in deferred tax. Right, so that therefore in calculating current tax, this is the format that you have got to follow. Right, you are going to say a current tax calculation. As usual, you start with your profit before tax. Right, based on the example that I gave you, 200,000 was the amount. Then you go to the question, you then check exempt differences. In this example with none, then you will have a figure remaining 200,000 here. Right, once you have that particular amount, then you proceed now to the temporary differences. So this is called here taxable income. Right, before temporary differences. Right, then you come here, you say movement in temporary differences. So you don't show one by one the temporary differences. Remember here, I had to show accrued expense. So it means if I had more, I would have listed them and their impact thereof. Some of them I would have deducted, some of them I would have added. However, in the exam, you are not required to show. You use this statement of financial position approach. Right, this method will require you to calculate the movement in temporary differences. Right, so you calculate one amount that you bring here, right? And after calculating that, right, you then have your figure of taxable income. Right, the question is, how do we calculate that particular amount? Right, that is the question. How do we arrive at that particular amount? Right, please hold on. Right, someone in the group is asking here. Right, let's see if I can answer a question. It is just telling this one. All right, let's continue. Right, so how do we arrive at that calculation of movement in temporary differences? Right, you must understand that what happens in the statement of profit and loss will affect the statement of financial position. Right, for example, if you have an accrued expense, right, remember in the statement of financial position, an accrued expense represents a liability. So therefore, as part of your liabilities, which would be a current liabilities here, right, you will have accrual, right, with a value of 50,000. So whatever happens in the statement of financial position usually has got an impact somehow on the statement of financial position. And this will be the carrying amount, right, of this particular accrual amount. Right, so what we need to do when we calculate the movement in deferred tax, right, based on the statement of financial position, right, we need to present in a table like this. So we are going to come here and say, right, calculation, movement, right, in deferred tax. So that's what we want to calculate. And then to calculate this movement, right, let's assume all of this is happening in the year 2025. Right, so all of this is applicable in the year 2025. And this is a new company formulated at the beginning of the year. Right, so what we need to do, we need to come here and say, right, for the year 2025. Right, then we say a carrying amount. Right, I don't think I will have enough space there. Right, then we'll say carrying amount. Right, then we say a tax space. Right, then we say temporary differences. Then we say deferred tax, which can be an asset or liability, and our rate is 27%. So now you'll be expected to formulate this table that I have here. Right, for each asset and for each liability, right, you will have to account for them on the table here. Right, so in our example, we only have one item of liability, right, which is accrued expense. Now, according to accounting, we have a figure of 50,000. Right, we have a figure of 50,000 there. This amount represents our carrying amount of the accrual. Right, all liabilities go in as a negative amount. Right, then we say, what is the tax base? Now, usually the tax base is the taxation's equivalent of carrying amount. So it is the tax value of an asset or a liability. Right. However, remember on this one, Tina, in accounting, we said in 2025, we incurred an expense, let's say it's wages, which we did not pay. So because we didn't pay them in the P&L, we allowed this expenditure to be deducted. So we treated this as an expense. But there is always double entry to each transaction. So in the statement of financial position, because we hadn't paid this, right, we debited the expense of wages with that amount, and then we are going to credit accruals. Now, accruals, that's a liability in the statement of financial position. Now, this is because we have already recognized this in accounting, we need debit, but we have not paid it, we need a corresponding credit, right, which happens to be the what? The accrual. So therefore, in the statement of financial position, we now have that, and that represents our carrying amount. But when we go to SARS, now remember on this particular amount, SARS is not recognizing it at all. SARS does not recognize accruals and does not recognize prepayments and does not recognize provisions. These things are only recognized by SARS when a payment has been made or received. Are we clear about that, good people? Right? SARS does not recognize prepayments, does not recognize accruals and provisions. Right here, I'm assuming the figures are below 100,000. I have never seen them confusing you with a figure above 100. So we are assuming all the accruals and the prepayments are below 100. Now, if SARS has not recognized this in the current year, then there is no tax base because it was never recognized by SARS. So therefore, in this instance, we are saying the tax base is 0 according to SARS. Now there is going to be a difference of 50,000. Now this is a negative amount. Then you multiply it by your 27%. So if you say 50,000 multiplied by 27%, it's going to give you 13,500. And this is a deferred tax asset. This amount will be a deferred tax asset. Right, good people, are we clear about that? Right, are we there? We are very quiet. Are we clear? Right, wonderful. So this year, 13,500 represents a deferred tax assets. Right, what to do? There is a movement in temporary differences, and this movement is negative in the current year, which means in the next year it's going to be positive. Right, this is a taxable temporary difference. Remember, a taxable temporary difference increases deferred tax in the upcoming years, but reduces it in the current year. So when you now calculate movement, right, in deferred tax, you are then saying what is, or movement in temporary differences, sorry. Right, so you want movement in temporary differences. Right, when you calculate the movement in temporary differences, you take the temporary differences of the current year, 50,000. So therefore, you 1,000, which is negative. Then you say less the temporary differences, so you'll be taking 2025. And then you subtract the ones for the what? End of the previous year. But we said this is a new company. It has not yet operated before. So therefore, the answer is 0, which means our movement is going to be 50,000, which is negative, leading us to a deferred tax of 13.5. So here you are multiplying by 27% on that figure. So for the tax, for the calculation of deferred tax, using the statement of financial position, this is how your calculations are going to look. Any question? Right, then what to do You now take this amount, which is your movement in temporary differences. This is the figure that you bring here. So you bring the amount of 50,000. So what happens if the amount here is a negative? When you bring it here, you are going to add it, and it will give you 250,000. And you can calculate current tax. Right? 250,000 multiplied by 27%, and you are going to have 67,500. If this amount had been a positive amount or a positive amount, when you transfer it to this particular slot, you were going to deduct it. Now, this is simple understanding of what this means. If you are having a negative amount, right, this here is an increase, right, in taxable temporary differences. What is a taxable temporary differences? It will lead to an increase in deferred tax in the what, or in taxable income in the future. But in the current year, it leads to a reduction, right, in taxable income in the current year. Right, that is a taxable temporary difference. That's what it does, right? It leads to an increase in taxable income in the future, but reduces it in the current year. Right. So you add it as long as it is negative here. When you bring it that side, you are going to add it. So you then get that figure. This is how they want you to present this information here. Any questions, good people? Right, are we understanding it? Right, I wanted to try and simplify it for you before we go to a proper question. But any question, are we understanding this? Right, I want you to remember something. When we calculate deferred tax, right, we compare the carrying amount versus the tax base, right, of assets and liabilities. Right, when we are dealing with assets, right, if the carrying amount of the asset is greater than the tax base, the resultant deferred tax will be a liability. Right, when the carrying amount is smaller than the tax base, the resultant deferred tax will be a deferred tax asset. When I'm dealing with liabilities, this is opposite. Right, if the carrying amount is greater than the tax base, then I'm dealing with a deferred tax asset. Right, if the carrying amount is greater, I'm dealing with a deferred tax asset. If the carrying amount of a liability is smaller, I'm dealing with a deferred tax liability. So what I've explained here is what we call deferred tax rules. Right, because every time that you calculate deferred tax, you must state whether it is an asset or a liability. And these are the rules that you apply. So if you come back here, you can see that we're dealing with a liability. The carrying amount was greater than the tax base, resulting in a deferred tax asset. A deferred tax liability you put in brackets. A deferred tax asset does not have brackets. So this is how we calculate and present. Right. Any questions, good people? Anyone with a challenge on anything that I have explained here? Right. Let's go to the question. There is a question that I shared in the group in the prior week. Let me just see if I can reshare it. Right. I'll retrieve it from the group and just reshare it again, just in case someone can find it. Right, now where is the question? Can't find it. Right, can I find that question? Can I find that question? I shared it in the group last week. I can't find it. It's okay. Let's go through the class. You get it after the class. Right, but you can still see it on the board. Right, so this is a typical question. It's actually a very frank question. As we go along, we'll do more difficult ones. But this is a very simple question that we have. Right, this is what it says. It's a prior assignment written by someone. Right, I don't want to look at number A. I want to start with number B. Number A, I will see it last if we do finish. Right, number B says calculate the deferred tax balance. Right, in the statement of financial position of Melo Limited for the year ended 31 December 2018 and 31 December 2019. Right, using the statement of financial position approach. Indicate in your answer if the balance is a deferred tax asset or liability. Right, that was for only 8 marks. Right, so you will always be asked your questions in this way to apply what we call the statement of financial position approach. Right, so we want to look at that. So this is number B that I'm looking at. Right, and I am expected to calculate the deferred tax balances. Now, what we do with deferred tax, you want to calculate movement. When you calculate movement, you start with the prior year, and then you calculate for the current year, and then you note the direction of the movement. Has it increased? Has it decreased? Depending on whether it is an asset or liability. So what we then do, right, we then have that particular table that I had created before. So now we present that table. We then say deferred tax here. Right, so for the question, they want you to show 2018 and they will also want you to show 2019. So we're going to start with the year 2018. All right, so we're going to have our table, right, with 4 columns. Right, so this is how we should present 4 columns. Right, and then here we say carrying amount, which is the value in the books of accounting. We then say tax base. Let me write in full. Let me write that in full. In the exam, they will accept even if you say CA. So this is the current or carrying amount, sorry, I wanted to say carrying amount. So they will say carrying amount, and then you have your tax base. Right, then you have your temporary difference. So you need to know which items give you temporary differences. And then you have your deferred tax, right, asset or liability, right. At the tax rate, you must be careful. Sometimes the tax rate changes between years. So don't rush to write the tax rate. You must check the question first before writing any tax rate. Right, so what I want to do, I will copy this also for the year 2019. Right, so you have to have 2 separate tables, one for the current year and one for the next year. Oh, sorry, one for the prior year, one for the current year. So our current year in this question is 2019. All right, so we have the same for the year 2019. Right, so what we need to do with this one, we need to check and say, what is the tax rate? Right, so we are very clear also that our year end is 31 December 2019. That's our year end. Then we go to the tax rates. The tax rates are usually provided towards the end of the question. Right, they normally give you the tax rates. Right, let's see if the tax rate were provided here. Did they provide the tax rate? Where are they? Right, or not number 5. Right, it says that the SA normal tax rate remained unchanged at 28%. So therefore, it's an old assignment. The current one would have said 27. So they were using 28 in both years. It had remained unchanged. So I said to you, you must not rush to put the tax figure because sometimes the tax changes from one year to the other. You need to use the correct amount of taxation. So this is our starting point here. But what are we going to use to populate our tables? Now, carrying amount is for assets and liabilities. So here we have to deal with assets and liabilities. That's what we are looking for. And those assets and liabilities are going to be giving us our figure of deferred taxation. So when you go to the question now, when you read through the question, you want to identify your assets as well as your liabilities from the question. Now, the question says, Mellow Limited is a manufacturer of marshmallow sweets. Right, the following information relates to Mellow Limited for the financial year ended 31 December of the year 2019. Then we are given the profit before tax. The profit before tax of Mellow Limited amounted to 1,450,000 for the year ended 31 December of the year 2019. After taking into account all the information below, the following items are included in profit before tax. Right, then we are given the items included in profit before tax. Right, we have the income tax received from Canada. That's foreign income. That's an exempt difference. Right, let's be clear. A deferred tax is a result of temporary differences. It does not result from exempt differences. So here we are looking at an exempt difference. Right, then we have dividend received exempt, director's remuneration. That one is just an expense that is included in profit, but it's neither an exempt or a temporary difference. Interest paid on late submission of VAT returns exempt. Right, and then advertising costs, 30,000. What is the story? These advertising costs were paid in November 2018 in respect of advertisements that were published in local magazines in 2019. Right, what is this in accounting? For the year 2018. Remember, our current year is 31 December. But we are being told that we have advertising expenses. These advertising expenses are included in our profit before tax amount. Then we are being told that these advertising costs were all paid in November 2018, that is in the prior year, right, in respect of advertisements that were published in the local magazines in 2019. Right, what do you call that in accounting? Of course, advertising is an expense, but how were you going to treat it? Right, good people, what is this? In 2018, that's a prepaid expense, isn't it?
Yes.
So that's a prepaid, but in the year 2018. So in 2018, since it was a prepaid expense, we did not account for it. We did not deduct it in 2018. We eventually deducted it in 2019. This is what they are showing you. Right, then we say a prepaid expense in the year 2018 would have represented a liability. Would have represented an asset, isn't it? A prepayment of an expense is an asset to the entity. So therefore, when we go to our books here, we will then say it prepaid expense. Remember, we are looking for what? Assets and liabilities. And then we say 30,000 was the amount of prepayment. That's an asset in the hands of what? Accounting in the year 2018. Right. Are we in agreement, good people? Hello there. Right. Are we in agreement there that this is 30,000 is an asset in terms of its carrying amount?
Yes.
Right. We have to understand what happens with taxation. Now, this is a prepayment. In 2018, right, we actually made the payment in the current year, even though in accounting we are going to account for it next year. Is SARS going to do the same? Right, what is SARS going to do concerning this in 2018? Right, when you make a prepayment in a particular year, right, SARS will account for it in that particular year in determining taxable income, isn't it?
Yes.
Right, so if SARS is accounting for it in 2018 in determining taxable income, then there is no balance now that remains. There is no asset that is recognized on your behalf by SARS. So according to SARS, this is going to be a nil, which means 30,000 temporary difference. Then we multiply that 30,000 by 28%, we are going to have 8.4. Right. We analyze and say, based on the rules, the carrying amount of an asset is greater than the tax base, which is 0, which means this is a deferred tax liability. So therefore, that will represent the deferred tax liability in the prior year. Right. Another way of looking at this, but this is claiming now, if this figure mathematically is a positive, remember it's a positive amount minus 0, it gives a positive. As long as the temporary difference is positive, then the deferred tax is negative. These two will never have the same symbol. If the temporary difference is negative, then the deferred tax will always be what? An asset. It will be a positive amount. Right, this particular prepaid expense does not apply to the year 2019 because in the year 2019, we eventually recognized this particular expense. And how do you recognize it? Right, by debiting the expense, whatever it is. All right, this is a prepaid expense, isn't it? We said we don't recognize it in 2018, but we create an asset, which is a prepayment. So in 2019, now we credit the prepayment and recognize the expense. So therefore, there will no longer be a remaining balance. The balance is now 0 in 2019. We don't worry about this prepayment anymore. Right. Any question on this particular asset and the calculation that we have on the board? Right. Are we clear on this, good people?
Yes.
Right. So we want to continue and say, from the question, is there any other asset or liability that we can pick? Then we go to this, number 2. The following is an extract from the allowance for credit losses general ledger account in the statement of financial position for the year ended 31 December. So this is allowance for credit losses. Right, allowance for credit losses is a provision, good people. What is a provision? Right, a provision is a liability of uncertain timing and amount. Right, but more importantly, a provision is a liability. So at the beginning of the year, our liability is 100,000. At the end of the year, our liability is 150,000. This is in the books of accounting. So being a liability, remember we are looking for assets and liability. So we then say allowance for credit losses here. Right, in the prior year, which is 2018, 100,000, this is a liability, it goes in brackets. Right, in the current year, we then have allowance, right, for credit losses. The amount is 150. Liabilities in our calculation, they go in brackets. Right, then we want to see what SARS is saying. What are their policies with regard to deferred tax? That's what we want to look at. Right, so we want to look at the policies of SARS. So the question will always give you the policies of SARS with regard to this liability that we have. So they say only 25% of the allowance for credit losses is allowed as a deduction for tax purposes. Right? Actual credit losses incurred are written off directly to the statement of profit and loss and other comprehensive income, not against the allowance for credit losses. Right? So, but for the purpose of tax purposes, only 25% of the allowance recognized by accounting is recognized by SARS. Right, you obviously deal with this issue of 25%, right, when you get to your module for taxation, maybe 3761, right, we have what we call specific deductions there, where they will give you more explanations of how you arrive at the 25. But here, for accounting purposes for this module, right, all we have to do is to read the statement because they will tell you the info that SARS only recognizes 25% of the allowance for credit losses. Right, so what it means when we go to the allowance for credit losses, SARS is going to be recognizing only 25% of 100,000, which means what is recognized as the tax value or the tax base by SARS is that amount, giving us a difference of 75,000. Now this here is in brackets. So 75,000 times 0.28, the deferred tax resulting for this from this particular line is 21,000. Right, based on the rules of taxation, if the carrying amount of a liability is more than the tax base of that particular liability, then the temporary difference are leading to a deferred tax asset. So we are going to have a deferred tax asset here. But remember, you can also just check here what you have. If you have brackets here, you won't have brackets this side. So therefore, it's a deferred tax what? Asset that you are going to be sitting on. Same with this here. Right, the 150,000 times 0.25, that gives you 37,500. Right, then 150,000 minus 37,500, that is going to give you 112. Mathematically, this is still a negative amount. Times 0.28, deferred tax here is 31,500. If it is negative, then it is positive there. Right, so this will be your deferred tax on the liability of allowance for credit losses. Any questions on this one from the floor? Right, are we on the same page, good people? Are we understanding this? Right, the good students are quiet, I assume they understand. Right,
Yeah,
now,
we can by bit.
sharp. If you don't understand, feel free to ask so that we explain. Right, on 18 December 2019, current year, the Board of Directors of Melo declared dividends payable to the following registered shareholders. Right, remember, we want to calculate our deferred tax, right? But more importantly, we want to calculate something that affects the statement of P&L. Remember, we are going to say profit before tax, exempt difference, then movement in temporary differences. So we want the movement in temporary differences arising from normal operations of the company, which means arising from income and expenses appearing before the profit before tax amount. Now we are saying this here does not affect the P&L account. When you pay dividends in accounting, they are not an expense in the P&L. You account for them via the statement of changes in equity. So they don't affect the profit before tax amount. We are not worried about this for now. So we jump that. Right, number 4. It says on 30 September of the year 2019, Melo Limited sold machine Franklin and replaced it with machine Puco because the production capacity of machine Franklin was limited. The details of the two machines are as follows. Right, so there are two machines. There is Franklin and there is machine Puco. Right, on 30 September 2019, right, Melo sold machine Franklin and replaced it with machine Puco. So at the end of the year 2018, we did have machine Franklin, but we did not have machine Puco because machine Puco was a replacement for machine Franklin, and the replacement is in 2019. So, but we do have a machinery in both instances. So we are going to have machinery. Right, we are going to have machinery here. Right, and also in this particular year, we are having machinery. Remember, we are busy looking for assets and liabilities. So these machineries, they represent assets. So we need to check and say, in terms of machine Franklin, which is applicable to 2018, what was its carrying amount? What was its tax base? Right, when we go to the question, right, we then check here, we're given the tax base in the year 2018. But for 2019, we were not given the tax base. Right, so we have the tax base of 682. Right, is it 682 or 672 there? Right, 672. In 2018, the tax base is given, we don't have to calculate. Right, don't worry, you will have chance to practice calculation of tax base in another question, maybe. This time it was given for 2018. Right, then we check again. We are saying, when we look at the question, right, we want to find that. Right, so in terms of machine Franklin, we are given its original cost, which is 180. Right, it was sold in 2019 for 900. The depreciation for the year ended 2018 was 210. But when was this asset acquired? Right, the purchase date was 1 January of the year 2018. So therefore, the depreciation for the year 2018 here represents the accumulated depreciation of this asset. Right, because this asset was bought in 2018, and therefore the depreciation for that year is actually it's accumulated. So we want to calculate here. Right, number one, we want to calculate the carrying amount. Right, in 2018. Right, when we calculate the carrying amount of an asset, good people, what do we take into account? What is the formula? It's a cost minus accumulated depreciation. Right, then we say, what is the cost of this particular asset? This was acquired at 840,000. So that was the purchase price or the cost price. And then we were very clear, the 210, which is the depreciation for the year 2018, is also equivalent to the accumulated because this was bought in 2018 and the value is 210. So we are going to subtract the 210,000 here. So when we say 840,000 minus the 210,000, right, then we are going to sit on 630,000. Now, this amount that we are sitting on, that's the carrying amount of the asset. Right, let's verify that the asset was acquired for 840. The depreciation was 210, which is 840 minus 210. So we then have 630. This is the value that we have in terms of carrying amount. So 630,000 minus 672,000, which was given already, we have a difference of 42. Mathematical, this is a negative amount. Smaller amount minus a big amount gives you a negative. Times 28%, we are going to have 11,760, and this is going to be a deferred tax asset. As long as the temporary differences are negative, the deferred tax is positive, representing an asset. Or if you want to apply the rules, it says if the carrying amount of an asset is less than the tax base of that asset, then the resultant deferred tax is a deferred tax asset. So you will be done with 2018 in terms of machinery. You need to do the same for 2019. When we go to 2019, this machine was sold before the end of the year. It was sold in September. Now, deferred tax is calculated at the end of the year, which is that 1 December. So we are no longer going to account for that machine because it's no longer there on that 1 December. So now we are dealing with this one. We want the amount of depreciation, right? But first, what is the cost of this asset? So the cost of the asset is 960. So let's calculate here in the year 2019. Right, so we want to calculate for the year 2019. Right, the purchase price of the asset, 960,000. It was bought towards the end of the year on September, and the depreciation up to the end of the year for you is calculated 60,000 for that machine. So that therefore, we are saying 900,000 represents the carrying amount, which is the book value in accounting. Right, we don't worry about the other machine. It's no longer there in 2019. Then that particular machine, this time they did not calculate for you the tax base. You have to calculate that on your own. Right, this is what they said. Right, the tax allowances, right, using the straight line method, but they are not prorated, is actually over a period of 5 years. Right, let's read further. Right, on their respective acquisition dates, the above machines were available for use as intended by management and also brought into use. All the relevant transactions relating to the above have already been recorded in the accounting records of Melo for the year ended 31 December. Now we are saying, let's calculate the tax base of an asset. So we have a chance to calculate the tax base. Right, the tax base of an asset is calculated in a similar manner to the carrying amount of an asset. Right, so you need the cost of the asset, right? In which case the cost of the asset is 960 there, which was given. So we take the 960,000 and then we say less tax allowances, right? For taxation purposes, we don't have depreciation. We have tax allowances, right? 960,000 is the cost, and the asset is going to be used for 5 years. So it's as good as saying the remaining useful life is 5 years. So therefore, we are going to divide by 5. Right, this asset, we are very clear. It was bought in the middle of the year. So therefore, in the current year, the asset was only used in October, November, and December, 3 months. However, the question is very clear. A tax allowance straight line method, not pro rata. We don't worry about the number of months. even if it was there for only 1 month in the year, we would charge a full year's tax allowance. That's what it means when they say not pro rata. When they say you pro rata, you do as in accounting by saying whatever value that we get multiplied by 3/12. But this is not applicable because of this. So therefore, we are saying the tax allowance would have been 960 divided by 5, which would have been a figure of 192,000. Right, so 960 minus 192, then we are going to sit on a value of 768. So this here is the tax base. Any question on the calculation of the tax base, good people? Are we clear? Right, are we on the same page, good people? 900,000 minus 768,000. We are going to get a value of 132. Positive figure times 0.28, we are going to get a figure of 36,960. Right, so this is how we were supposed to calculate the depreciation here, and it will be a liability. Remember, positive figure here means a liability there. Right, let me just check something. I want to see if really indeed we did not make a mistake here. Right, they were very clear. The tax base was given. It's 672. Then here we said 840 minus 210. That gave us 630. Everything is correct. Any question, good people, from the floor? Are we clear? Right, we are very quiet. Right, I hope quiet means we are understanding. Right, wonderful. Then we continue. Right, we then have Melo Limited made the following provisional payments for the year ended 31 December. Right, what is a provisional tax payment, good people? This is a prepayment of taxation. So remember, a company must pay income tax, and income tax is payable at a particular point in the year. Right, usually you should be done with your taxes on the last day of your financial year. However, SARS does allow companies who qualify to register on a provisional tax basis, which means they can pay taxes in advance. Right, let's say my year is ending on 31 January of the year 2025. This is my year. Right, however, I'm a provisional taxpayer, and I'm expected to pay on, say, 30 June, right, and also on 31 January. Right, let's say based on my calculations, I estimate, because the provisional calculation is usually an estimate, I estimate that I'll pay tax of 30,000. Of 60,000. Right, and then I'm paying half yearly. So if you're paying half yearly, you are allowed to pay half in your first provisional payment. And then you pay the other maybe provisional payment. Let's say I've changed my estimation. I thought I'd underestimated. I end up paying 30,000. Now, let's say my eventual income tax amount, right, is actually 200,000. Right, I will then need to pay the difference, 30,000 plus 35,000 I have already paid before the payment is due. So now I just need to pay the difference, which will be an amount of 135,000. So this will be payable to SARS when my tax season kicks in. So this is a system to allow a taxpayer to not wait for the end of the year and have a very big update in terms of cash flows, but to allow the taxpayer to make regular payments before the tax is due, so that when your tax is due, you have got a smaller amount to pay. So it's a win-win for the taxman and also for the person who is paying. For the taxmen, at least they don't have to wait for the end of the year to collect cash. They collect taxes periodically throughout the year. So they are liquid throughout the year to fund government expenditure. So that's the understanding with provisional tax. Right, so this is not an additional tax or anything of that sort. It's just a prepayment of your tax. So it won't affect us in our calculations here. Right, so when we are here, we then close our calculations. Right, and calculate the value of the deferred tax. So we then add 30,000 negative positive, which is that value, right, minus 75,000 minus 42,000, which means ultimately I'm sitting on 87,000, which is negative. That times 0.28, right, will give me 24,360, which is positive. So if I add across here, I should get the same figure there. Right, then I say 11,500, which is negative, plus 132,000 positive. That gives me a positive amount of 19,500. Multiplied by 0.28, that gives me 5,460, which is a negative amount. Right, so I've calculated the deferred tax of the prior year. I've calculated the deferred tax of the current year. Now, to conclude this, I need to calculate the movement. Right, in temporary differences. Right, to calculate this is easy. What is your temporary difference figure in the current year? Right, our temporary difference, that's a positive amount of 19,500. Right, in the prior year, it's a negative amount of 87,000. That is the temporary difference figure. So we have 87,000, which is negative. Right, a positive amount minus a negative amount is as good as saying 19,500 plus 87. Right, this will give us a figure of 106,500. So this is our movement in temporary differences multiplied by 28%. This is going to give me 29,820, which is a negative amount. Now, this is my movement in temporary differences. This is my movement in deferred tax. The movement in deferred tax, I can take it from saying I had deferred tax of 24,360. Or, sorry, you start with the current year. I have now a deferred tax of 5,460 negative, less the deferred tax in the prior year, which was 24,360 positive, right? What am I going to get? 29,800 and what? 40, which is a negative amount. Right, so for the 8 marks that we're looking for, this is what we were expected to compile. Are we clear, good people? Are we on the same page? Right, so obviously this calculation in will be there. Yes, ma'am.
Would I be wrong if I just add the deferred tax for 2018, 2019 because I get the same amount? But I do understand that we need to go that way. Or is that a way of calculating if the amount is correct?
Okay, you mean in calculating this amount here?
Yes, the movement in temporary deferred tax.
You don't add, you say this figure minus that figure. Right, the reason for that is because we want to calculate the movement. If these were positive amounts, right? If this was a positive amount of 10,000 and this was a positive amount of 5,000, if you add these two, you will now get 15,000, right? But that would be incorrect because you are supposed to say 5,000 positive minus the previous figure of 10,000. The correct figure now will be what? Minus 5,000. Don't add them. Right, are we clear? Don't add the figures. Prior year deducted from the current year, or current year minus the prior year. We are saying, what is the movement? Or how much have we changed by? So it's very simple. You had a negative amount of 87. Now you have a positive amount of what? 19.5. It means that your temporary difference, you added a positive amount of 106 to the 87,000 to arrive at a positive 19.5. So you are looking for the movement. Same with the deferred tax. Please don't add them. You will get incorrect figures. Current year minus the prior year. That's the correct way. So you can see that this figure, there are two ways of combining it. I can do this calculation, get this figure, then this figure, multiply by 28%, I'll get the figure. Or I can just say my current year, right, minus my prior year. I will still get the figure. So this was your requirement number 1. Right, or number what? B, for 8.5 marks. If you are doing 3701, your first assignment will look almost similar to this, just that you'll be having different maybe information to study. But you will calculate the deferred tax. And then immediately after that, they will want the current tax calculation. So calculate the current tax due to SA Revenue Services as it will be disclosed in the Statement of Financial Position of Melo Limited for the year ended 31 December. The movement in temporary differences in the current tax calculation should be calculated using the Statement of Financial Position approach. You should use the information calculated there. Right, so now we want to know the current tax, which is the amount that we have to pay to SARS. So we'll come here and say current tax amount. Right, on the current tax, we always start with the profit before tax. We always start with the profit before tax amount. Right, on the profit before tax amount, right, we will take the profit before tax amount that we were given, right, which is the amount of 1,450. So here they said the profit before tax of Melo Limited amounted to 1,450,000. So therefore, we'll get the amount of 1,450, right, 000. Then we'll say exempt differences, right? Or sometimes they say non-taxable or deductible items. Right, so usually that description is for CTA, non-deductible and non-taxable. Right, so now we have to go to the question and identify the exempt differences. The exempt differences, we are going to line them up one by one. Right, so it says the following items are included in profit before tax. Income received from Canada. The income received by Melo Limited from Canada is not taxable in South Africa in terms of double taxation agreement. Melody paid foreign taxes amounting to 84 million. Right, so this is foreign income. It's under a double tax agreement. So therefore, it is not taxable in the hands of the taxpayer in South Africa. It's exempt. So we say foreign income. The amount is 400,000. So for accounting purposes, it was added because this is income in arriving at that profit before tax amount. Right? It was added in arriving at that amount there. Right. However, for tax purposes, it is not taxable. It doesn't lead to tax expenditure. So we need to reverse it from the profit before tax by deducting it. Income, you deduct; expenses, you add them. Right. Dividend received 8,000. So this is dividend income. Right. Dividend income is not taxable in the hands of a corporate shareholder, which is a company. So therefore, it represents an exemption. In accounting, it is included under other income. But for tax purposes, it is not. We are going to deduct that amount. Right. Director's remuneration. Right. This is not an exempt difference. Fines paid to the metro, 6,000. Right. Of course, the fines to any arm of government, this is an exempt difference. The amount is 6,000. It was deducted in arriving at the profit before tax. So what do? We reverse by adding it back. Expenses you add. Right. Interest on late submissions of VAT, arm of the government, that is SARS. Right, the value of that 8,000, this amount we must add back. You are not allowed to claim a deduction. Right, so these are the apparent ones that were given. But remember, we also have 20% of capital gain. Right, what is a capital gain, good people? Right, what is a capital gain? Right, a capital gain is the amount by which the proceeds on the sale of an asset, right, exceed the original cost of the asset. Only 80% of that is allowable as taxable, or is taxable according to SARS. We did sell an asset, which is the machinery. So you must double check if there was a capital gain or not. A capital gain will only exist if the selling price exceeded the original cost of the asset. The asset was bought for 840, but it was sold for 900,000. Right, so therefore we're going to say 900,000, right, minus 840,000. Right, then the answer that you have, you are going to multiply by 20%. Right, so that will be clumsy. Let's just do it on the side. So multiplied by 20%. Right, we are reversing only 20% of that figure. Any question there, good people? Are we understanding it? Right, this is a gain. A gain represents income. We have to deduct that particular figure there. Right, so that eventually, right, remember it's a gain. It was included here as part of what? Profit on disposal of assets. But we are saying SARS only recognizes 20% of the capital gain portion. So we have to deduct it. Income, you deduct; assets, you, or expenses, you add back. So 400,000 negative plus 80,000 negative plus 6,000 plus 8,000 plus 12,000 negative. We are going to sit. I made a mistake somewhere. I've got 78,000 it cut. 400. All right, that's 6,000 plus 8 minus 400 minus 80 minus 12. All right, I should have 478. Right, which is a negative amount, paying the total of the exempt differences that I'm adjusting. So at the end of the day, 1450000, minus 478,000. Then we are going to sit on 972, right, 000, which is taxable income, right? This is taxable income, right, before temporary differences. Then we bring in movement in temporary differences. Right, movement in temporary differences. Right, so this is what we now bring on. Right, just answering someone in the group. Right, the movement in temporary differences now, you go and take this figure. Right, if it is a positive movement, we are saying this is a taxable temporary difference. It will increase taxable income in the next period or in the future. Right, so what it means is that it will reduce taxable income in the current year. So if it's a positive, when you take it to the next side, you deduct. How much did I get today? 106,500. So it will come here as a deduction. Right, so that therefore you now have taxable income of 865,500. And this here is taxable income. Right, then you can calculate your current tax amount. Right, by saying 865,500, the tax rate 28%. Right, then you are going to have a figure of 242,340. Right, then you say less provisional payment. Remember, some of these figures you have already paid. Right, your provisional tax payments were given. You paid 6,575. Right, 60,500 plus 75,000. You have already paid 135,500 here. Right, so that therefore, what is payable is the difference. Right, so you have a figure of 106, right, 840. Now, in the statement of financial position, under the current tax payable, you will now sit on 106,840 because you have already paid a portion of the 242,340 that you were having there. So that is how you calculate your current tax figure. You don't have to list the temporary differences one by one. You calculate your deferred tax via the statement of financial position approach. And you note down the movement in temporary difference, which is the figure that when you are now calculating your current tax, you simply bring in that movement in temporary differences, right, in the manner in which we did here. Right, any questions, good people, on this? Are you understanding it? Remember, a calculation like this is a given in the test. If you're doing 3701, this is your first assignment. And in the exam, definitely without fail, it will be there. Any question? Right, chat with me. Any question, good people?
No, sir, it's clear.
Right, wonderful. Let's see what else they wanted in that particular question. Right, where is my question? So we have answered number B and number C. Right, number A or number D says disclose the income tax note, including the tax rate reconciliation, using rand values in the notes to the annual financial statements of Melo Limited for the year ended 31 December. Right, usually the calculation ends with disclosure requirement. Right, so I'm going to demonstrate how you show the disclosure for such for such a calculation. Right, so let's go to number D. Let's go to number D. Right, so when you do disclosure, it is the name of the company first, which is, I think it's Melo Limited. And then you say notes for the year ended. Right, the year end is the 31 December. Of the year 2019. Right, then you say profit before tax note. So this is disclosed under the profits before tax note. And then you say a profit before tax includes the following disclosable items. Right, then you will have this is not profit before tax. This is not profit before tax because we're disclosing tax. Sorry. Right, you go straight and say income taxes here. Right, or you can say income tax expense. Right, you can just say income tax expense here. Even if you say income taxes, you'll be correct. Right, remember the calculation of income tax. What are the two components of the calculation of income tax for people? Current tax plus deferred tax. So therefore you say major components. Right, you say major components. I'm not going to complicate this. I'll make it simple. Right, but in other calculations, when there are more details involved, the disclosure may be complicated a bit. So I'm not going to worry about things that are not on this question. Right, then we say current tax. Right, then we say deferred tax. Right, the current tax amount that you are going to disclose here is the amount before any payments, which is this file. Right, 242,340, that's what I use. Then I go to the deferred tax. Right, on the deferred tax, I want the movement. On the deferred tax, I want the movement. So I go to the deferred tax here, calculation, and say, what is the movement in deferred taxation? 29,820. Right, a taxation can either increase, right? Remember, the income tax is an expense. The income tax is an expense. Right, it can represent an increase in profit or a decrease in profit, depending on what is happening. Or, all right, let me put it this way. We are trying to calculate the income tax expense here. Right, what we do, we put this amount on as an expenditure. So it goes in as a positive amount, representing an expense. Then the deferred tax amount here can either increase or decrease that particular expense. The deferred tax can be an increase or a decrease on the amount. Right, what we do, we go and check the movement. If we have a negative amount here, then 29,840 will be a positive here. Right, it will represent an additional expense. So that therefore we are saying our total expense from the operations of the company, we add the 242,340 plus the 29,840, right, to give us an amount of 272, right, 180. When we are claiming, we just remember when you move the amount. If it is a negative amount here, you are going to add it there. There was a movement in deferred tax which resulted in an increase in deferred tax liability. But how do you get a deferred tax liability? What would have happened? Let's go to the earlier discussion. Right, where do my discussion start? Right, deferred tax liability. Where did I discuss a deferred tax liability? I think I was here. Right, a deferred tax liability. Where did I show that? Right, I gave you this example here to say, assume that your tax expenditure according to accounting is 80,000, but you pay less. Then you are going to have a deferred tax liability because you underpaid your tax expense. You only paid 60,000 when your tax expense is saying what? 80,000. So you have a deferred tax liability. So given the current tax, if you have a deferred tax liability, if you add them, you go back to what? The income tax expense according to accounting. So this is what we are trying to do. We are trying to calculate the income tax expenditure, right, using this reconciliation. So therefore, we have come here, we have the current tax. We know that, income tax expense for the statement of P&L is deferred tax plus the current tax. So the current tax portion we now have. And then the deferred tax that we have in our calculation is a liability. So to get the income tax expense, you have got to add the two. That is what we are doing. So that represents what is called your normal tax. This is your normal tax or tax from your South African operations. Any question, good people, on that? Right, then you add in your foreign tax. Remember, this company is not only paying South African tax, they are paying foreign tax. And the amount you were not calculating here, it was given. Right, so this is what they said. Income tax received from Canada. The income tax received by Melo Limited from Canada is not taxable in South Africa in terms of double taxation agreement. Melo Limited paid foreign taxes on this income of 84,000. So therefore, they paid an additional amount of 84,000. So that ultimately, our total income tax expense, we have to add these two amounts. Right, so if you go to the statement of profit and loss, right, under other income, this is the amount that you are going to disclose there as your income tax expense for the year. Right, any questions, good people? Are we clear? Right, are we on the same page? Right, you are very quiet. I want you to ask questions when you don't understand, so that when you get a recording and you're sitting on your own, right, we will have addressed some of the concerns maybe, or some of the areas that are gray, and the video will be more informative. So feel free to ask whenever you don't understand anything. Right, then the last thing that we need is what is called a tax rate reconciliation. Right, so here we are saying a standard tax. Right, we had profit before tax of 450,000. Right, multiply that by 28%. So if you say 1,450,000 times 0.28, we are going to have 406,000. And now, if we did not have exempt differences and temporary differences, this would have been our tax. Why are we not having that tax? Because we have this figure here. So we need to see what the reconciling differences are. What makes our tax 356,180 instead of what? 406,000. Now, this is because in this instance, we had exempt differences, which we did not include in calculating this. But how did we calculate this figure? By factoring in current tax and deferred tax. In calculating current tax, we did not include exempt differences. We eliminated exempt differences. But here in our calculation, we have not eliminated any exempt differences. So therefore, our reconciling items are the exempt differences. So we go to the exempt differences. We had foreign income. Right, we have dividend income. We had fines. We also had interest. We had capital gain. Right, remember here on the 450, we have already calculated the tax component here. But when we were calculating in the current tax, it was before applying taxation. So you will see that here we had 400,000, 8,000, 6, 8, and 12. So we have 400,000, we have 80,000, we have 6,000, we have 8,000, we have 12,000. Now, these amounts were before taxation. So since this figure already taken into account tax, we are going to multiply them by 28% to reconcile them appropriately. Right, 12,000 by 28, we then have 3,360. Now remember, this represented income always in brackets. 8,000 multiplied by 28, this is an expense, always we add back expenses. Fines 6,000 multiplied by 28, which gives us what? 1.680, right, which we add. Dividend income 8,000 times 0.28, that gives me 22400. Now that one, we were subtracting its income. But there is a special adjustment that we need to make, right, for only the foreign income. Right, foreign income, yes, it was removed from the calculation here, so that when we now included this 42,000 in our calculation of current tax here, it was devoid of that 400,000. However, with regard to foreign tax, we did add 84,000. So this figure here contains 84,000 in tax on foreign income. However, this figure here contains 400,000 by 28. We must less the difference between the two. So therefore, we say 400,000 by 0.28, the figure that we get minus 84,000, we are going to sit on 28,000 here. This is the amount that we are going to deduct. Right, these are the only reconciling items in this question. We add everything together. 406,000 minus 28,000 minus 22,400 plus 1,680 plus 2,240 minus 3,360. We are going to get back to 356. Right, here I got 160. Why am I having 160? Did I make a mistake somewhere? Let's see. 406,000 minus 28,000 minus 22,400 plus 1,680 plus 2,240 minus 3,360. Right, I'm still getting 160. Why are we having a difference here? Right, 242,340 plus 29,840. Right, I got that. But let me just double check here. Right, the mistake is coming from here. This is 29,820. So that should have been 29,820, not 40. Right, so it will be 242,340 plus 29,820, which gives me 160 here. Right, which gives me 160 there. Right, so that now we have exactly the same amount. So remember, we are reconciling this figure and that particular figure. If they balance like that, it means everything is 100% there. Right, any questions, good people from the floor? Are we understanding? Now,
Yes,
this
sir.
type of work should be on your fingertips. Text is very important because if you now go to other topics, you still have to apply the same principles. All the other topics now you'll be dealing with taxation unless if they tell you not to do that. So if you don't understand tax here, you are likely to struggle with taxation in other topics. And that will be a very big problem. So this topic you must sit down on until you understand. If you don't understand, you stay close to the tutor, you ask questions, and then we will explain until we are on the same page. But this is very, very important. Right, any questions, good people from the floor, any additions? Right, we are going to meet again, I think, because I was meant to combine the class with CTA, but CTA is having another module. So there was a bit of a clash on that on our side. So we are still going to do this class during the week. So what I will do, remember we're supposed to be in the same class day. Right, I'm going to do similar work, but I will just do a different question. Right, so that for you guys, when you come in, if you have attended today, you will have extra practice. So just do a different question, not this one. And then those that are not here, at least we'll give them a recording. So we make sure that we attend also the next one. Right, I'm just trying to check the date in my timetable here. Right, where is my timetable? Right, but I think we meet on Tuesdays, isn't it? We meet on Tuesdays for CTA. So you guys can attend for now with the CTA guys. What I'm teaching is the basics of deferred tax there, which is the same as what you are learning here. But later along the way, I'll add a few things that you guys don't have, which are only for CTA. Yeah, so Tuesday at 6:30 p.m., let's meet again for another practice session on this one. Right, for now, we are done. Thank you very much, unless if there is a question from the floor.
Thank you, sir.
You, sharp, sharp.
I've got a question, please.
Yes, ma'am, you can continue.
Will you maybe share examples with us so that I can prepare for the next class? It's my first class today, and I
Oh.
haven't paid for my registration, so I don't have any study material at the moment.
All right, anyone who does not have a study guide, please inbox me. Ne? I will have to, I'll share it on WhatsApp if you inbox. Ne?
Okay.
Yeah.
All right. Thank you.
Right, thank you, good people. Sharp, sharp.